It's 7:05, so I think it's about time that we get started. So today I would like to introduce to everybody Ritesh. So he heads Syfe's investment advisory team, and today he'll be actually speaking on the market outlook for Q3. Joining us is also Richard Ye, who heads the portfolio construction and risk management. He'll be helping to answer some questions and also touch on some pointers himself. So I think Ritesh, you are starting.
All right, great. Thanks, Melvin, for the introduction. Hi, everyone. Welcome to today's webinar. This is our Q3 outlook for the market 2020. We started our outlook series last quarter. So first quarter was when it was the peak of the crisis and essentially everything was shutting down. And now we are at the stage where things are starting to open up again. So it's becoming like a new normal per se. But through the 2020 period, we have gone through a roller coaster ride when it comes to the markets. There has been 2 quarters of unprecedented volatility. And what that has also done is the world has changed around us. If you started Q1 and start of the year 2020 versus where you are now, a lot has changed since, the start of the year. So let's start by looking at what are the top concerns or top things that are coming to mind with respect to investors. So there are briefly or mainly these 4 things, right? Essentially people are looking at what kind of recovery can we look forward to. People have thrown around different recovery paths, a U-shaped, V-shaped, L-shaped, W-shaped. So all sort of letters have been thrown around. So we'll dig in a little bit deeper in terms of what are the plausible scenarios that can take place going forward. Of course, with the equity markets being in that kind of a roller coaster ride, there are concerns in terms of how far this equity rally can last. So what are the risks both to the downside as well as the upside? So I'll discuss a few things around that. And then lastly, as an investor, how do you position yourself given the current market situation? So those are the top things that we will cover in today's seminar. All right, so agenda-wise, we'll first take a brief look at the markets, how it has fared over the first half of 2020. We will look at the different paths to economic recovery. What are the risks and concerns? How do you sort of design your investment portfolio to sort of remain resilient through these kind of market situations? And then a little bit of an introduction to Syfe portfolios, how they could be relevant to solving some of these needs per se, and a little bit more in terms of how do you get started on a platform. And then we'll wrap it up with Q&A. Of course, throughout the session, please feel free to use the Q&A tabs to post any questions. Melvin will keep a tab on them, and when we cover different topics, I will pause in bits and pieces, so I'll be happy to cover some of them. And alongside me, Richard is of course joining us as well. So any technical in-depth questions if you have, please feel free to post, right? All right, so let's get started. Okay, so it's really been a story of 2 quarters, right? If you look at what happened in the first quarter, the market sort of fell off a cliff, right? If you compare this, it almost looks like a crevice within a mountain. So the kind of drawdown that happened, which was from peak to bottom 35%, it is something that has never happened before. So the pace at which the market fell from the peak level in 19th of February to 23rd of March, which was the bottom, has been unprecedented. So there has been no occasion before this where a 34% market fall has happened in such a quick time frame. And what is even more surprising is the recovery that has taken place. So within a 2-month time period, if you look at Q1, we had a 20+% drawdown for Q1, but in Q2, there is a 20+% rally that has happened. And if you put that in context again, from a rally standpoint, this is one of the biggest rally since 1938, right? So eclipses all the big rallies that we have seen. Now, how do we sort of rationalize this? Because if you look back the whole of 2020, the first half, the coronavirus pandemic has spread all over the world. And even now there are cases of resurgence and divergence in terms of how the coronavirus thing is playing out in different parts of the world. And we don't have a vaccine yet. And still a lot of countries are not totally opened up. Demand has not come back. So what sort of justifies this kind of market rally? I mean, one justification that people say is that essentially markets are forward looking. So essentially the idea is once things go back to normal, all the companies will get back to their feet and demand will come back, and essentially we go back to pre-crisis levels. But there is, I think, a little bit more to it in terms of why we have seen the kind of unprecedented rally that we've observed over the last couple of months. And just to put that in context, it's a little bit of a technical chart, but if you look at what has happened, the white line is essentially the global money supply. If you look at what has happened from a policy standpoint, both from the governments as well as central banks, is that as the market tanked, there was a liquidity crunch. And what the governments across the world did was a coordinated effort to bring in more liquidity into the market. And to do so, they printed a lot of money and they increased spending from a fiscal standpoint as well. So all that money pumping is what actually led to a lot of liquidity into the market and sort of led the rally back as well. So if you look at the green and the yellow line, that's where you see the MSCI World Index, which is in yellow, and the SPY or the S&P 500 Index making a huge comeback since the lows on 23rd of March, right? And if you look at the correlation, you will observe that during this time, the amount of money that has gotten printed is just enormous and unprecedented as well. So, very well, depicted in terms of if you look at what has really led the rally, it's really the money printing from the central banks and the enormous amount of spending that is happening to sort of mitigate all the demand loss that we have seen across the world. Now, let's look at a little bit more details. So when we look at S&P 500, which is the US stock market, there is, of course, also a divergence in terms of how the different sectors have fared. So if you look at on the right-hand side, so let's first look at, the drawdowns. So all sectors, had drawdowns during the crisis, the peak of the crisis. So falling as large as 35 to 40% if you look at like banks, oil and gas, all of these demand-heavy, physical demand-heavy sectors per se. But even the technology and healthcare and other sectors which have since fared well, very well, they also had some sort of a drawdown, more like 10, 20% plus. But the subsequent recovery is what has been uneven, right? So if you look at, again, the technology, healthcare, pharma, retail, some of these sectors, they have been able to come back from the lows of the market, and now they are almost in positive territory. A lot of these sectors are now in positive territory. And the reasoning for that is pretty straightforward. When you look at all the demand-heavy sectors, not the whole demand has not come back. Oil and gas companies, both in the downstream, upstream, and the users of those, fuel consumption companies per se, all of them have not gotten back to, pre-crisis levels in terms of demand comeback, because right now, again, there is some sort of a COVID resurgence, plus, the countries are in a much more measured state to open up their economies full-fledged. But when you look at the high growth companies, technology, healthcare, all of these have been in the forefront, where essentially what has happened is more and more demand has sort of shifted online, and more of these high tech and consumer discretionary or consumer staples or more stable sectors have been the beneficiaries of it per se. So overall, S&P 500 is now in the positive territory. And if you look at across the global asset classes as well, for the first half of 2020, this is a little dated. So this is end of June. Right now, S&P 500 is in positive territory. So the US is in positive territory. But in terms of actual asset classes, some of the more safer haven asset classes have outperformed in the current crisis. So whether it is high grade bonds or investment grade bonds or cash or money market kind of instruments, and similarly more of large cap oriented stocks, growth oriented stocks have done well. Also portfolios which are well diversified, allocated to different sort of assets across the board, not just in one particular thing, have done fairly okay. Things that have not done that well include the more small cap oriented stocks, value stocks, again, demand driven stocks. Some of the EM and international stocks have since started to come back over the last month or so, but overall they're still down 10+%. Now, I think the important question is, given the current situation, what is the path to economic recovery? And if you look at the different scenarios, these are some of the various scenarios that can potentially play out. And again, we took this data from McKinsey, where they have done some research in terms of getting an understanding as to what are the different scenarios that can actually play out. So if you look at the chart on the or the axis on the left, it basically talks about how quickly the spread of the virus can be contained. If it can be contained in a very rapid and effective way, then it's the better, right? So the higher you move up, on the axis, the better it is. Similarly, on the right, on the x-axis, what you're seeing is what are the kind of interventions that the governments are placing in the economy. So whether it is fiscal, economic stimulus, as well as other measures to make sure that all the economic loss that we have seen, the kind of recession that we are undergoing is not as deep as what potentially will happen if there is no intervention per se. So all the economic policies sort of play a role, and if there are highly effective interventions, things will look much better in terms of the actual economic recovery. Now, in terms of plausible scenarios, I think if you look at right at the middle, A3 and A1 are more of the plausible scenarios, and where most of the respondents in terms of doing the survey have placed their bets as to how the economic recovery can sort of actually happen in practice. So again, people have thrown around different letters, whether U-shaped, V-shaped, L-shaped, W-shaped recovery, but looks like it's going to be a sort of U-shaped but prolonged U kind of a recovery, if you may say so. Now, let's look at some of the factors that are determining the global growth and how global growth is sort of coming back. On the left-hand side, we have the global manufacturing data. So this basically, gives you a glimpse of how the global economy is sort of getting back on its legs, right? So if you look at the first half of 2020, China bore the early brunt of the coronavirus. And essentially, that's when the shutdowns and all happened. So if you look at the manufacturing PMI data, the red part in China shows up in February. But from an optimism standpoint, what you see is post the controls that were placed in China, post the lockdowns were released, the manufacturing activity actually picked up. And then there is a path to recovery that you can see for them. Now, of course, the rest of the world, the pandemic subsequently played out. So you see that in March, April, most of the manufacturing breakdown in terms of growth numbers and all are actually negative territory for across the world. So I think, again, if you take a leaf out of China, if things go back to normal, that's where I think the rest of the world can follow as well. But again, there is a caveat there that in China, per se, there were more stringent measures that were placed. And what is happening right now across the world is you're seeing that there is a more resurgence of the virus per se, but some of the economies are still opening up because essentially they have no choice at this point of time, because otherwise, things will get much worse from an economic standpoint. Now, if you look at the graph on the right, this is where we talk about how the global GDP numbers are looking like in terms of going forward. And again, if you see China, that is where we see that, okay, there was a big dip in terms of GDP numbers, but subsequently the recovery comes in. And for the whole of 2020, actually for China, you can still look at either a slightly positive GDP print or just even. But if you look at the other markets such as US and Europe, that's where you see, I think there is again some sort of a divergence because, yes, we are coming back on the recovery path, but post the recovery, the activity levels still might not come back to the pre-crisis levels. So that's where I think both the US as well as European markets, you might see a negative GDP print for the whole year. And the actual full-fledged pre-crisis level activities might only come in 2021, 2022 per se. So that's something to be, noteful of. And I think, again, from the standpoint of policy responses, what we have seen is there has been a huge support from the different governments across the world, and it's been a coordinated effort to make sure that the impact of this particular crisis is contained as much as possible. And when you look at this particular data, essentially it talks more on the fiscal support that the different governments have been placing. And if you look more closely to the US, you are seeing almost 12% of the GDP numbers as a fiscal spending that has come in from the US government and the central banks. And again, on top of that, there are also loans, guarantees, and there are asset purchases that are happening in a fairly high manner to sort of support the markets and make sure that we don't have a liquidity crunch per se. So all of these fiscal measures, I think, are definitely required. These would help for us to keep the interest rates low, keep the liquidity high. It'll encourage more spending. And what I believe is, essentially, this will sort of continue for the near future because, there is a continuous demand for, the Fed and the other central banks to keep supporting the economy. Just to, again, give you some snapshot in terms of, how big this support has been. So just in the last 4 to 5 months, the Federal Reserve has actually pumped in $2 trillion in support in terms of, spending, in terms of, money printing, which is basically, if you compare back to the crisis that happened during the financial crisis 2008, from 2008-9 to 2014, the total amount of money that was printed by the Fed or the support that came in was $1.5 trillion. So just in 3 to 4 months, we have seen more support and more sort of policy response coming in compared to almost 5+ years of support that came in from the Fed during the financial crisis. Now, I think before going into this, I think it's also begs that question that, with this kind of money printing, where are we going? Is this something that is sustainable? And what will be the implications of so much money getting printed? And we will cover that a little bit into our next section, where we will talk about what are the risks and concerns of the markets as we go into the next few quarters. Again, I think some of the leading indicators from the US market, you can see that in 2020 first quarter, second quarter, actually, the actual GDP numbers went down by, more than 30-40%. So it was down 38.9%, but subsequently we are, seeing that there will be a demand come back and almost 20+% GDP growth that will come in Q3 and subsequently as well. So for the whole year, still we are looking at -7% as the GDP growth numbers for the US market as a base case. But overall, if you look at further down the road, 2021 is where you see that the GDP numbers start printing to be positive per se, right? And again, all of the other data points as well, if you look at unemployment numbers, all of them have started to come down a little bit. So looks fairly optimistic from those standpoints. Before going into the risks and concerns, just wanted to take a quick break to see, Melvin, if there are any questions.
None whatsoever, actually.
All right, great. Richard, do you want to add something till now for the macro parts?
Yeah, I think you basically covered it, pretty well. But the only point I wanted to make is this: that all of this, I guess, analysis that's been presented, I just bear in mind that everything is unprecedented. The Fed basically has increased its balance sheet from 4 trillion at the beginning of the crisis. In less than 6 months now it's over 7 trillion, right? So you just imagine in 6 months they've doubled their balance sheet, and the whole reason is because we've never gone through this kind of financial crisis, which has been precipitated really by a lack of demand. Because once you have this coronavirus, it's not a financial problem, it's not a supply problem, it's not a misallocation problem. It's just everything shuts down, and everything shuts down. The problem that you face is very unprecedented. And I think we will probably talk a little bit more about that later on in this risk and concern section. But some of the actions that you see the Fed do, even in their stimulus of the markets, is unprecedented, because in the previously, what the Fed used to do was, when they pump money into the market, they will basically be buying treasuries. This time around, they basically bought corporate bond ETFs. They bought corporate bonds directly, right? So there's a lot of stuff they do because they're trying to basically address, illiquidity in the markets. Because all of a sudden, for most of us Singaporeans, you look at SIA. It is basically our flagship company. It is doing so well, and all of a sudden, within 6 months, it's grounded most of its feet. And it's just recently they say they lost the last quarter they lost $1.12 billion, right? So it's really mind-boggling that in such a short time, when you close demand, what can happen, right? So just bear in mind that whatever statistics we show you, whatever analysis we show you, this is actually people's best guesstimate, and I would emphasize guesstimate because nobody really knows. Okay.
Right. So I think that begs the next section, I guess, right, in terms of how should investors think about the markets right now? What are the chief risks and concerns? And based on that, how do investors position their portfolios going forward, right? So I think I covered in the previous slide how things are looking a little bit more optimistic in terms of demand sort of coming back, not to the full extent, but still coming back to a certain extent. But at the same time, if you look at certain other leading metrics, unemployment claims, they continue to rise, right? So essentially what has happened in the US per se is that they opened up the economy, there was a resurgence of the virus, and initially the unemployment claims started to come down. If you look at end of March to early May, that's where the number of unemployment claims skyrocketed. But then subsequently it started to come down. But as you see the resurgence of the virus, more states are again sort of clamping down, and the number of unemployment claims have started to rise again. As you can see, from the print in July last week, it is 1.4 million plus. Now, I think what is more important in this is there is also a continued claims number that comes out, and which is, I think, now I suppose more than 16 million. What this means is, if this crisis prolongs for a fair bit of time, you're already seeing companies going bankrupt, and more of these unemployment numbers might become permanent in nature, right? So there can be a situation where these jobs never come back. And how do we address that kind of a situation is something that is for us to be fairly concerned about. Another part to again mention, and this one actually talks about the current state of the COVID-19 crisis. Now there are 16 million plus cases in the world. I think last time when we did this webinar, there were 1.5 million cases, and there were only around less than 100,000 deaths. So now I think fast forward 3 months, it has again exponentially grown, right? And this thing is sort of growing again, because if you look at the graph below, the initial peak happened, the parts where the peaks were starting to happen were more China first, then Europe, and then shifted to the US, and then all the countries coordinated both on the monetary fiscal standpoint as well, but also by clamping down their economies. So that's what led to a little bit of dampening in the number of cases initially. But since then, what has happened is all the economies, all the countries had to take some hard decisions in terms of partially opening up their economies, and some of them even much more optimistic in terms of fully sort of opening up, almost fully opening up their economies to bring back demand. But what that has sort of led to is a resurgence of the virus. Number of deaths have increased, and now the focus has really shifted to countries like US, countries like the LATAM, and also within Asia. Now if you look at India and other countries, that's where most of the virus cases are now starting to pick up again. I think very important to also think of US elections, because this is something that is going to happen over the next 5 months, and possible trickle-on effects to the US-China relationship, as well as the trade risks per se. So just to give you some statistics from a US election standpoint, what has been observed is, and this is a webcast that was hearing, when an incumbent actually goes back and takes office, the stock market in the US usually goes up by 5%. But if the incumbent loses, then on average, the stock market goes down by 3%. So, what I suppose is, we don't know what will exactly happen, but, given the uncertainty around elections, around the geopolitical risks that US-China is having as well, And if the V-shaped recovery that everyone was thinking of, it'll happen, if it doesn't happen per se, and that basically might mean that, if Trump has to change the narrative of, what is happening and how he's sort of, keeping US first, things might sort of worsen between US and China till the election time before things get better, right? So again, these are important things to consider, and these will actually mean that the volatility in the market can continue to be high. Of course, the unprecedented level of volatility that we saw in February and March might not come back, but given all of these other risks that are still prevalent in the market, there might be all these elements that can continue to contribute to the volatility in the market. And then I think another important thing to note, I think it goes a little bit too technical, so I'll just try to cover it a little bit faster, is around the US Treasury yields and how they're now going into much lower levels. So if you look at on the graph on the left, the 10-year Treasury is right now hovering around 0.6%. The 5-year is somewhere around 0.25%. What is more important is the inflation adjusted numbers for these yields. So when you adjust for inflation, when you look at the real yields, they're actually already in negative territory, right? So that is something that is important for us to note. And given that the nominal yields cannot be taken down, there is not too much room for the nominal yields to be taken down further. It just puts a lot of pressure on US dollar as a currency, as a base currency, as well as other markets per se, or other asset classes like gold, which become like more of a safe haven currency in these times, right? So I think important to note this. There has been talks of the Fed reducing the interest rates to negative territory. This is something that the Fed has said that we will not do per se, and they will continue to use other measures, which things that Richard mentioned earlier, which is asset buybacks and buying into corporate bonds and other such instruments to continue to provide that liquidity to the market per se. But at a certain point, we don't know how things will pan out, and if a negative US nominal rate were to take effect, that can have a much wider impact in terms of how the US dollar and its relationship with around the world with other currencies, as well as certain safe haven assets like gold might react to it. So I think Richard, if you want to cover this part, I think it is interesting to highlight this on the gold front, and comparing it with how the US FX market and all is playing out.
Yeah, I think most of you following markets will know that gold has been having a very good run, and this chart actually is very good because it sort of illustrates why gold has been running up so much. Okay, so the kind of like a brownish chart is obviously the gold. And prices on the right hand side, the right vertical scale. On the left hand side is basically the 10-year constant maturity. That means the nominal bonds minus the break even inflation rate. Okay, so what that really is it's your real returns. Okay, so real returns now have basically moved all the way down to negative territory. As Ritesh showed you in the earlier chart. So essentially, gold, if interest rates are high, and gold doesn't give you any interest, then it's a drag on gold, right? As you've seen over the last maybe preceding 5-6 years, right? But once the interest rates come down, in fact now effectively on an inflation-based basis, that the on a real cost basis. The market is actually paying you to hold gold, right? Because it's negative real returns, for the U.S. Treasury. So I think this is one thing that we look at now. The question is, will gold continue going up? Well, if interest rates continue going down, the Fed continues printing money. The U.S. Congress is now talking about another $1 trillion, stimulus package. And so what happens is then, that they will issue bonds, and then the Fed will buy the bonds, and it will basically monetize. So once it starts monetizing, the real interest rates are not going to keep going down. I mean, there's not much choice, right? So that's why, everybody all of a sudden, I guess, I did a seminar on with the World Gold Council a couple of years back, and everybody except the central banks, were very negative on gold, right? But all of a sudden now you see all the private banks, all the high net worth individuals, it's almost a must do to have a portion of your allocation in gold, right? So that is kind of like an insurance situation. So the way you can look at it is, gold as an insurance product, the cost of insurance is going up. I mean, it's not funny, but I mean, it's just, if you didn't laugh, you would cry, right? I mean,
right. No, I think makes a lot of sense. And again, as part of any portfolio that investors are looking to construct, I think gold, holding a little bit amount of gold and these times is definitely warranted. And while we don't recommend to sort of overload on gold on one asset class, but it is definitely an asset class to be added to your overall portfolio construction, and we can go over it in more details later as well. I think the next one is actually pretty interesting. I think I really love this particular slide, just to talk about how the global and the S&P 500 markets have gone up to such a high degree, and the correlation of that with all the so-called Robinhood investors, where there has been a huge surge in investor activity and trading activity per se as well. So just to give you some context, I mean, during the last 3 months, so last quarter, in the US, Charles Schwab opened 6x the number of accounts that it usually opens for one quarter, right? So 6x that number. And more specifically to Robinhood, they had more than 300% active accounts. So their active accounts went up by 300% during the last 3 months. So again, goes to show that in the current crisis, what has essentially happened is with so much money getting printed, and then there are not too many assets to sort of park your money to, right? Like if you're thinking about fixed income, there is actually no yield for you to sort of capture. If you're thinking about putting money to your savings account, actually you're earning zero interest. And if you're looking to do anything else, there is basically no money to be made. So all the risk premia is sort of remains and in the equity market. And what has happened is with all these platforms, making it so easy for you to make trades and gamify the whole aspect of trading, it has really led to a huge surge in investor activity without, I think, doing any fundamentals analysis per se, or having too much basis in terms of the markets. So just to give you another example, I mean, Tesla, again, I was reading this, the Tesla stock has again gone up like 10, 15, 20 times. I don't know how many times it has gone up, but essentially in terms of just volume, the options market of Tesla is $200 billion on average right now, which actually eclipses the sort of option market trading volume if you look at the Eurostock market. So the whole Eurostock market's trading volume is actually lesser than Tesla. That's just boggles my mind in terms of how that is possible. And it's actually now even in terms of the S&P 500 trading volumes, it is giving it a run for its money. So again, right now I think what is happening is a lot of trading activity is getting triggered and driven more from a FOMO standpoint, that I missed out on the rally, I want to participate, or there is a sort of some rumor or something about a particular company and everyone just loads upon it. So people are trading tickers rather than actually stocks, and this is something that we should be like very, very careful about, because while there have been huge upturns in terms of some stocks that have gone up a few X times, it is not something that I believe will continue to happen, and there is very, very high risk in having a strategy like that. And a lot of investors have already suffered with those kind of strategies per se as well. So again, like if you look at this data versus if you look at the chart on the right, this basically talks about how smart money versus dumb money is investing, right? So if you look at the part at the bottom, when the line goes on the red axis, that's where people are a bit more apprehensive. The smart money or the institutional investors are a bit more cautious rather than aggressive. And this is when actually the dumb money is sort of going all on and participating in the market per se. So while again things are looking a little bit more optimistic, things are looking a little bit more positive, and it is looking like most of the world is sort of trying to come back on its feet. There are encouraging signs in terms of vaccination trials and everything. But having said so, I think it is important to still be a little bit more cautious of the markets rather than going by the flow and just participating from a momentum standpoint into things that might not you don't have much idea about. So that I think brings to the next topic of how do we actually design a portfolio or think about investments given these uncertain market conditions. And again, I think the biggest point that I will have is for long-term investors, it is very important to not get into that whole FOMO aspect of things as to missing out on the rally. Rather think and have a very long-term view of your investments. Keep your investments diversified. Don't load up on just one or one particular asset class or one particular sector per se, but have a little bit of a wider approach at this point of time. So as I said earlier, the only free lunch left right now is diversification. So if you look at this chart, it's a little bit all over the place, but the right way to sort of absorb what it is trying to convey is look at the top row of the chart. You will observe that there is no one color that dominates it. What that means is there is no one particular asset class that gives you consistently high returns year over year over year. What that essentially also means is rather than putting all your eggs in one basket, spread it across different asset classes such that there are those mitigating factors and helps you to remain invested and keeps your portfolio stable for the long term. One more important point is just an asset level diversification might not mean that you are diversified from a risk standpoint. And this is something that was proven when the market crashed in the February and March period, where essentially everything got correlated, whether it was stocks, bond, even gold for that matter, everything fell in tandem. So if you just have a 60-40 portfolio, doesn't mean that you're actually well protected because you are asset diversified. A 60-40 portfolio from a risk allocation standpoint can still have a 90+% risk to equity market and only a less than 10% risk to the fixed income market. And the reason I say that is, like, suppose you have $100 to invest and the $100 during a market crash becomes $90. So even though you had 60% into stocks and 40% into bonds, 9 out of that $10 loss will actually be contributed because of your stock exposure, and only less than 10% will be contributed because of your bond exposure. So again, other than asset diversification, you should really also look at risk management as an important component of your asset allocation and portfolio construction. And that's why I think it is very important to protect your downside and have a strategy that helps you do that and achieve that. Because again, point to highlight is during the market crash, peak to bottom, the S&P 500 bottomed out with a 34% correction. If you lost 34%, you need 50% sort of recovery to go back to even. So the fact is, if you lose much less, you don't really need to recover that much. So if you lose only 10%, you only need 11% recovery. And that's where I think the power of protecting your downside becomes much, much more important. And again, stay invested, right? Again, the markets will have its ups and downs. If you look at this chart, if you extend your time horizon, if you're only invested for 1 year, you can have a very good year or you can have a very bad year. Like last year, the S&P 500 was up, I think 30+%. This year, it is just flat. It went down 34% at one point of time, and we don't know if there is another wave coming, and the markets can fall further. But if you extend your horizon to 5 years, 10 years, 20 years, you'll observe that the number of negative return periods that you might have significantly goes down. And if you look at the bottom half for 10 and 20 years, essentially, this data goes back for the last 150 years. If you invested your money for a 20-year horizon, starting at any 1 year and ending at, after 20 years, you would have never lost money, right? So again, it is very, very important to not get perturbed by the market fluctuations from the short term. And part of that can be achieved by, making sure that your portfolio is diversified, making sure that you're portfolio is risk managed, and having that stability in your portfolio will ensure that you remain invested, and then actually have those profits and build your wealth over time. I think one important question that a lot of people ask us is, should I do a DCA or should I do a lump sum? I think, if you look at just these graphs, I won't spend too much time into it, but essentially lump sum actually wins more number of times than a DCA strategy, because over a longer horizon, as I said earlier, there are going to be a much more positive return aspect to your portfolio. So over a longer horizon, if you do a lump sum, because it's a naturally upward trajectory market, you will end up making more money. And 70% of the time, you will actually make more money if you do lump sum versus DCA. But given where the markets are, I think I would approach this problem in a combination standpoint, where I would do some lump sum, but I will also do DCA. And the way I would decide what strategies to do lump sum on and what strategies to do DCA on would be a little different. For example, if I want to do lump sum, I would actually not put it into a 100% equity portfolio, because what if there is another 10-15% correction? I don't want the portfolio to straight away, after deploying, have that kind of drawdown per se. So, I think it is more pertinent for every one of us, again, as discussed earlier, to invest your lump sum money into a risk-managed, globally diversified portfolio to begin with, and then do your DCA, because no one knows when the market bottom is. If we knew when the market bottom was, we would have gone and invested all our monies in 23rd of March when the current bottom happened. So and again, we don't know if that bottom will be reached again, right? So you don't want to completely miss out on the upside as well. So the best strategy to do is do a DCA on a high risk portfolio or an equity only portfolio, or whatever that one particular asset class that can give you high growth. Do a DCA on that, because that becomes an automatic risk management strategy per se, right? So that can be one way for you to sort of think of building your portfolio. All right, so in summary, what have we learned? Essentially, I think the worst is over. It is looking a little bit better. Economies are coming back on their legs, but doesn't mean that we should be complacent. So again, the markets will continue to be volatile. If you again think of what is happening, and with all the central banks pumping in so much liquidity into the market, and they're in a way anchoring all the other asset classes, right? Like if you think about all the asset purchases that are happening for, say, the treasury bonds, for the corporate bonds and other such bonds per se, all of them have now come into a mechanism where because of the Fed support, their prices and everything gets anchored, so there is not too much volatility for you to observe. Even on an FX standpoint, I think it will be yes, the US dollar is coming off, but to a certain extent, I think it will be muted, and there won't be a catastrophic sort of decline in the US FX rates as well. So I think what I would recommend is yes, things are looking much, much better, but don't get complacent. Build a diversified portfolio, protect your downside risk. Most important, stay invested. And from the standpoint of actually, making a little bit more, or being a little bit more opportunistic, do a DCA strategy to buy into the dips of the market rather than trying to, time the market per se. All right. So now, before going into the Syfe portfolios, I'll quickly pause a bit to take any questions.
Okay. So one question that Nelson asked is actually, any plans to implement a SGD hedge option for the equity 100 portfolio?
Right. So see, I think the whole aspect of hedging a portfolio itself is a topic of discussion, and there are costs to hedge a portfolio as well. So while yes, we can easily build a SGD hedged share class of the equity 100 portfolio, there is no guarantee that the hedge will actually help you sort of mitigate the risk of say US dollar depreciation. And I think and Richard can allude more to it. We had actually done this analysis on all our existing global portfolios previously, where we did a comparison of if we hedge the portfolio versus we don't hedge, what the cost of hedging, if we take that into account, is it actually worth it or not, right? So again, I'll
actually
to Richard to explain more on that again.
Yeah, actually we actually did do a study, because obviously this is this is an obvious question, right? Because basically we're all Singaporeans, and then not all, but I mean most of us are Singaporeans, and our base currency is Singapore dollars. And so when every time you go overseas and invest, then what happens is there could be a currency depreciation, right? And even when the Singapore dollar was appreciating very strongly, what we did was we actually did a study where we showed, okay, supposing if you just blindly hedge, okay, that the cost of hedging will over 20 years totally dominate, any currency gains that you have in being long the Sing dollar, So essentially, you buy US dollars and you hedge it, you would actually lose more by paying the cost of hedging than you would if you just held the US dollar and watch it depreciate. Okay, so I mean it's kind of a little bit ironic and quite sad. So the only way that you can actually benefit from a hedge is to basically time the market and basically judiciously hedge. And the problem is that we talked to a lot of experts in the foreign exchange markets, and this is a very difficult kind of a task, right? So we're still looking, but it's a little bit like a holy grail, in currency management. It's not something that is so easy to do. And even if the Singapore dollars has been appreciating, this is not over the last few years, but let's say look back 20 years, Singapore dollar has appreciated against the US dollar. But even you will take the depreciation, you lose less than if you just blindly hedge, all the time, right? So that is an issue. So typically, if you look at the academic studies, I don't want to prolong this thing, but if you look at the academic studies, typically for equities, typically the academic wisdom is that you don't hedge, right? Because the currency is built in some way, and you just totally unhedged. But if you are running a bond portfolio because your returns are lower, then you should really be looking at hedging it, right? Because hedging is really talking about interest differentials, and it's more relevant in running a bond portfolio. Okay, so typically, I guess from our portfolios, we have not hedged because we find the cost of hedging is too high.
Right. And I think just to add on to that, the other part being, if you had invested into a USD portfolio, even over the last 15, 20 years, even on a currency adjusted basis, you would have definitely made much more money than you invest. Like from an equity market standpoint, the Singapore market is pretty narrow, and the returns of the STI index hasn't been that great, right? So if you compare what you would have gotten in a globally diversified equity portfolio, which is USD denominated, and even the SGD has, it is not the phenomena that the SGD is appreciating over the last 3 months per se, or the last 1-2 months per se. The SGD has appreciated against US dollar even in the last 15, 20 years. But even on a sort of currency adjusted basis, you would actually do much better investing in a more global portfolio from that standpoint. So there is one aspect of hedging the currency, but the other aspect is also like even if you don't hedge and have a full exposure USD portfolio, I think that's a much better way to sort of orient yourself from a growth objective standpoint.
Great, thank you. So another question, do you have time?
Yeah.
Okay, so speaking of gold, are there any plans to have a portfolio that is focused in commodities or the energy sector?
Richard, I think this is for you.
Well, we always respond to clients. Like for example, I saw previously there was a question that equities are so high now. Why are you offering an equity 100 portfolio? And really the background to that is that we offered equity 100 as a carve out because clients wanted it, right? I mean, our core flagship portfolio is our global portfolio, which is what we call automated risk managed investment, RE, right? And the problem is that because volatility is so high and we manage risk, looking at volatility, that what on average, let's say it's a 60% equity, 40% fixed income portfolio, all of a sudden becomes, 30-70, right? And so our clients all said, look, you guys, why are you guys so conservative? We want to participate in the stock market rally and so forth. So as a result of customer demand, what we did was we said, okay, if you guys want to take equity participation and you are prepared to do a core satellite strategy, then we will carve it out and offer it to you, right? So I think so far we have not really had overwhelming demand for a commodity portfolio, partly because commodities other than precious metals have not really been doing well, right? So now with gold coming on stream and silver, silver is the other thing that's all of a sudden popped up. There may be some demand for inflation hedging assets, right? So to the extent that we can, you notice that in our global RE portfolios, we do have gold in there as an inflation hedge, right? And that's kind of part of the insurance, that's built in for our diversified portfolios. But we have not really thought about building, a commodity-based sleeve because so far there's really been no customer demand for it. Ritesh, do you agree with that?
No, absolutely. So yeah, I think while we would love to build as many portfolios as plausible, but at the same time, I think we do incorporate some of these elements into our global portfolios. So I think that would be a better way to do it rather than again, we are not a brokerage platform per se. So I think it is important that we construct portfolios taking into account the risk return metrics. And by investing into the global portfolio, you do get exposure to gold, as Richard mentioned. So please do explore that for now. And if there is sufficient demand, we might consider.
Great.
Shall we move on? All right. Okay, so let's now look at some of the Syfe offerings and how you could, potentially use these portfolios to achieve, both your long-term, short-term, and core satellite approaches per se. Right. So, okay, so Syfe, right now we have 3 different portfolio offerings. So the first one, our flagship portfolio, is our Syfe Global Portfolio. The Syfe Global Portfolio is basically diversified across asset classes. So it has equity, bond, and gold as the underlying asset classes that we invest into. The unique thing about our global portfolios are that they are downside protected. So they are risk managed portfolios. Typically, when you go and ask for a combination portfolio of equity, bond, and gold, you will typically be sold a moderate risk, aggressive risk, conservative risk kind of a portfolio. The good thing about our portfolios is that we quantify the amount of risk that you're taking, and what that means is your downside risk or the downside drawdown is sort of limited to that number that you choose for your portfolio, right? So rather than doing an asset allocation, we do a risk managed portfolio, which definitely helps a lot of clients to remain diversified as well as protect their downside per se. In terms of building blocks, the global portfolios are built using top ETFs across the world. So includes the likes of BlackRock, State Street, Vanguard, Invesco, and others. And our flagship, I think the most popular portfolio, which is the 15% downside risk portfolio, has annualized given 9+% returns over the last 10 years, right? I think from an objective standpoint, a lot of people use the global portfolio as their core portfolios. Again, the point being, it is supposed to be stable. It is supposed to be risk managed. So you can't go too wrong. It will remain fairly resilient through different market cycles. And this is something that actually happened in the current crisis as well, where our global portfolios were very, very stable and they did not have the kind of drawdowns that the wider market experienced. And because of that, people remain and investors remain much more calm during the whole process of the drawdown as well as the recovery. But having said that, I think overall, there was this demand of folks who wanted to do a pure play exposure or get a pure play exposure to the equity market because they wanted to get a full-fledged participation in a growth-oriented portfolio. So what we did was we introduced a 100% equity portfolio, which has elements of smart beta incorporated, and I can go over more of those parts later. But the point is, like, this is a 100% equity portfolio where if you want to participate, you want to do a monthly DCA, this could be a portfolio that could be relevant for you. So pure equity, very, very high growth, high return, high risk kind of a portfolio that a lot of people have shown a lot of interest in. But I mean, we highly recommend to use it more as a portfolio, which you can, in the current market context, to do more like a dollar cost averaging on. And I think more from a local standpoint, we offered launched our Syfe REIT Plus portfolio. This is one of the more popular portfolios that we have on our platform. This is built in close collaboration with Singapore Stock Exchange, where they have licensed their index called IHS REIT Leaders Index. And the idea of the REIT portfolio is to generate some sort of a passive income. And because REITs also grow in prices and have a capital gains aspect to it, people do use it even as a growth portfolio by reinvesting their dividends. So the good thing about the REIT portfolio is younger investors use it as a growth portfolio. A little bit more older, middle-aged investors or semi-retirees or retirees use it more as an income portfolio per se. And the great thing about the REIT portfolio, again, is it is tied to a tangible asset class, which is the real estate market in Singapore. It is Singapore dollar denominated. So, to the earlier question that we had around, sort of hedging the currency risk, this portfolio doesn't have a direct currency risk per se because it is Singapore dollar denominated. So you will have a sustainable sort of dividend stream coming in. And REITs as an asset class is required by law to pay out 90% of their dividends as, 90% of their income as dividends. And that's why, REITs become a very, very, good tool for people to generate some sort of a passive income. So for 2019, we saw the REIT portfolio giving north of 5% dividend yield per se. And then lastly, I think for the REIT portfolio, we do have two options. Like, you can choose a 100% REIT portfolio or a portfolio of REITs with Singapore government bonds to bring in an element of capital preservation to your portfolio. And given that now we have so many portfolios, we have a dedicated advisory team as well. So if you don't know what to choose, which portfolio to choose, in what proportion to choose, and you're not sure how to get started, I think definitely utilize our advisory services to get a better idea how to get started. Now, getting a little bit more into details of all the portfolios we talked about, I think I already covered some of these aspects. In terms of the investment strategy of the global portfolio, this is fairly technical, so I'll just high level cover it. Basically, we use the best of breed investment strategies in terms of constructing the portfolios. So how much of different asset classes should be present in what proportions, all of that is sort of determined using Nobel Prize winning research, including, sort of frameworks, which is called global markets portfolio, as well as risk parity portfolio. And then, as I said earlier, we don't follow a traditional asset allocation, which, has a top-down approach where first they say that you're a moderate risk, so let me give you a 60-40 portfolio. You're an aggressive risk, so let me give you an 80-20 portfolio. Rather, we first ask you the question, what is the maximum drawdown that you're willing to take on your portfolio? And based on that, we will construct a portfolio that can basically contain your drawdown to that level, but at the same time, maximize the return for that level of risk. So that particular aspect is what determines our asset allocation rather than, asset allocation to be the top driver per se. Now, in terms of returns, I think, again, we have listed down all our different risk portfolios for the global offering. So we have 11 different downside risk portfolios, ranging from 5% downside risk to 25% downside risk. It's a little bit, too detailed to see, but essentially what you can concentrate on is the 15% downside risk portfolio. Look at the current composition, the average composition, and the annualized returns. What you will observe is this 15% portfolio on average has more like a 60-40 allocation, 60% to equity, 40% to bond and gold. But because it's a dynamic asset allocation model where we sort of target a particular risk level and the risk level determines the asset allocation, in the current market, we have seen that the portfolio has become a little bit more defensive to ensure that if the markets have big drawdowns, we are able to mitigate those situations much, much better. And if you look at, from a return standpoint as well, the higher risk you take, the higher potential return. But at the same time, this is something that is personal to each and every person. So if you're someone who is not willing to take a 25% kind of a drawdown and you would end up selling your portfolio, it is much better for you to consider a lower drawdown portfolio, something like 15% per se. I think the chart at the bottom talks about our portfolio performance, specifically the 15% downside risk performance, and it basically, is showcasing it against the S&P 500, not the fair benchmark per se, but just goes to show you how the 15% downside risk portfolio performed through the crash and through the recovery. So what you'll observe is through the crash, the portfolio actually did not lose much, right? So when the S&P 500 crashed by 34%, the Syfe 15% portfolio only crashed by around, I think, 12.5%. And then subsequently, as the markets recovered, we did not fully participate in the rally because we are now a little bit more defensive. But even though we did not recover that much, because the fact that we lost so little, overall, we are doing roughly almost the same. And if you even compare with our relevant benchmarks, we are roughly, similar lines in terms of overall net return. And I think the great thing about having a strategy like this is now coming into the current market situation where the markets again have rallied so much, a lot of people don't know what to do. I would actually be much more confident to invest my money into a portfolio like this rather than into a portfolio which is, super equity heavy, right? So again, we'll be a little bit more defensive, a little bit more, risk managed, diversified, and that will help you navigate through the current market in a much, much better way.
And Ritesh, if I may just add the previous slide. Now this actually happened real time, okay? And so what happens is that two things. One thing is that how do we know that we can actually manage this thing? So we do something called point-in-time back testing. And in 2008, we went through exactly this same scenario. And when we back tested it, we found that our drawdown was more or less in that same order. And so what happens is that a lot of people, a lot of our prospects and our clients ask us, you do back testing. Back testing always works, right? I mean, so how do you know that going forward it will work? So what we do is you do this thing called point-in-time back testing, and we were very confident that it would work. And this is actually proof of the pudding that what we back tested actually came to pass, right? So we can actually look at what our back tests show, and we can actually be very confident, that this will happen if the situation happens like this. Okay. And the other point that I would make is this: as we go through this crisis, there were a lot of clients that basically came back with the feedback to say, what are you guys doing? The market's going down, and you're selling into a down market. You're selling a new low, so you buy high and sell low, right? But the point is, when you talk about high and low, that perspective, is only afforded you, when you look backwards, right? When it's happening to you, there's no way to tell whether the market's new low or new high, right? So of course, when you buy something and the market goes down and you sell it, it's always buy high, sell low, right? But the market can go lower, right? Which is what happened here. So this is our methodology to protect your downside. Okay.
Right. No, absolutely. So, Richard, thanks for sharing that. And essentially, in summary, what we are trying to say is that alongside having a diversified portfolio, it is, very pertinent to have a downside protected portfolio like this. And again, in a there might be some sort of underperformance, overperformance, but over time you will see the markets are down. And when the markets actually really normalize, that's when we will see that the risk managed portfolios will actually help you participate more on the upside, because then essentially we will increase the allocation to equity to a much, much bigger extent. Now, I think to address one particular need where people wanted a way for them to deploy a more kind of a DCA strategy into the market, they wanted a pure play equity portfolio where it is much better or much easier for them to rationalize the returns of their portfolio versus the market. We came up with this equity 100 portfolio, and again, thanks to Richard and Akiko for designing such an effective portfolio for us. Essentially, the idea of coming up with a 100% equity portfolio was to address that particular need where people need a high growth pure equity exposure, and they want to remove the hassles of doing it and choosing the individual ETFs themselves or individual, stocks themselves, because, at the end of the day, when you try to, number one, time the market, try to pick up your individual stocks, there is just a lot of implicit and explicit cost, right? The implicit cost being the time that you're spending to just analyze the markets and then, determining which stocks to buy, how much to buy, and what proportions to buy, and when to rebalance. And more of the explicit cost of, each time you're entering and exiting, you're incurring a brokerage cost, rebalancing cost, dividend reinvestment cost, and other such things that become relevant when you're doing active trading and buying into the equity market. So to address that, we came up with a strategy where, on a risk-adjusted basis, rather than you deciding what to buy and what proportion to buy, we do the hard work for you. And rather than just buying into a market cap oriented equity portfolio, which is, say, an S&P 500, one argument would be, let me just put all my money into S&P 500. Why do I need to do this? What you will observe is, again, if you look at from a pure finance standpoint, what is observed is that just a pure market cap oriented portfolio might not give you the best risk-adjusted results or risk-adjusted returns per se. There are really some factors that drive returns to an equity portfolio or to portfolios in general. And if you can extract out those factors and focus your portfolio to cater to those particular factors, you might get a little bit better risk-adjusted return for your portfolio. So smart beta, in very layman terms, basically means that instead of weighing your portfolio in market cap oriented manner, you weigh your portfolio to certain factors that actually drive returns per se. And that's why in our portfolio, what we did was we analyzed a lot of factors. We analyzed growth versus value. We analyzed, large cap versus small cap. And we also analyzed, low volatility versus high volatility stocks. And what we observed was, just given each one of these factors have a long sort of time frame where, they become like the more prevalent factors, and the sectors that are exposed to those factors actually continue to do very, very well. So right now you would observe that growth basically has done much, much better than value. Large cap stocks have done much better than small cap stocks. And even from a going forward standpoint, I truly believe that these are the sectors and factors that will continue to drive the returns in the near term per se. Because if you look at value stocks, typically they are more of the stocks which are old economy, and what that means is the demand needs to really come back for those sort of sectors to recover. But also from the standpoint of even if they recover, even if the demand comes back, their capital expenditure will take a significant hit because they're not generating much earnings right now, versus all the growth and technology companies continue to do very, very well. They're continuing to generate very high revenues, and their profitability remains very, very strong. So they have much, sort of bandwidth to remain, very aggressive and keep, their growth engine intact, right? So from that standpoint, I think it is, pertinent to look at growth as one of the sectors to invest into. More from a large cap, small cap standpoint, if you look at, again, small cap stocks right now, is a little bit harder for them to survive because they have lesser access to capital, or, the large cap stocks per se have stronger balance sheets and other things as well. So from those, viewpoints, I think it is important to have those tilts to a growth oriented, to large cap stocks, and even to low volatility, sort of sectors per se. So, while the growth stocks and all might do well, it can be fairly volatile. To balance it out, I think if you focus on certain sectors which are, say, consumer staples, these are the evergreen sectors. So whether you're in a recession, whether you're in a bull market, these sectors will continue doing well. So I think we focus on these factors to construct and do the hard work in terms of making your portfolio, and that is what actually leads to these kind of returns. So on an annualized basis, again, if you look at the equity 100 portfolio, close to 10% return. But I think if you look at a little bit, actually this number is not correct. I think the equity 100 portfolio is 13.2%. I think for the last few years. Sorry, this is 15 years data. So 10 years data, and I think for some reason the number is not correct. But essentially, equity 100 was 13.2% return versus S&P 500 was 10.2 for that same period. And even on a risk-adjusted basis, the Sharpe ratio of the portfolio is much, much better for the equity 100 compared to S&P 500 or even the MSCI World. And even if you look at from a trailing standpoint over the last 10, 15 years, right? Okay, so yeah, you see, right? Like, last 10 years is 13.4% for equity 100 versus on S&P 500, it is 13.2. And last 15 years, it is 10.1 versus 8.7, right? So that's the right number actually. Yeah. So I think the number on the left one is on the 3-year basis. But if you look at the longer term 10-year, 15-year data, you really see that these factors contributing to the higher risk-adjusted returns. So both from a absolute standpoint in terms of return, but also from a risk-adjusted standpoint, you will end up making better return overall. And lastly, I think it is the REIT portfolio. So REITs, as I said earlier, you have two options, whether to construct a 100% REIT portfolio or risk-managed REIT portfolio as well. So if you go for a 100% REIT portfolio, it will track the IHS REIT Leaders Index. If you go for the risk-managed REIT portfolio, we will add Singapore government bonds to the mix. And the idea is for the risk-managed portfolio to again target a 15% drawdown for your portfolio per se. And again, these portfolios are freely switchable. You can switch between the two portfolios. The idea behind the risk-managed portfolio is that you build in that element of capital preservation. So while your yield goes down a little bit, but as you will see in the next slide, I think overall the returns of the risk-managed REIT portfolio actually has been much better compared to the 100% REIT portfolio. So left-hand side bottom, you will see the 2020 returns is something that has resulted in the overall last 3-5 year return of the 100% REIT portfolio to be a little bit lower than the risk-managed REIT portfolio. And again, the reason of that being the downside being protected for the risk-managed REIT portfolio, really helping it to go into a positive territory overall. And again, once an actual recovery happens, of course, the 100% REIT portfolio will start to, again, outperform a bit. But the idea is, depending on what you're trying to do, if you're looking for high yield, then you can go for the 100% REIT portfolio. If you're looking for a little bit more capital preservation, then and you can live with a lower yield, then you can go for a risk-managed REIT portfolio as well. All right, I think this is an important slide that I thought would be very relevant in terms of thinking through how do you actually use the different portfolios that Syfe has to offer. And what we thought is, let us do a case study. Let us think of an actual client that we have and what kind of asset allocation has the client done. So if you are a typical, say, a client who is 40 years old, looking to deploy $100,000, and you have a 20-year horizon because your retirement age is 60, you can roughly look at a core and satellite approach to your investment portfolio, wherein essentially there are a few objectives that the client has. Objective number one being retirement. So, if you look at the pie chart right at the center of it, some of the objectives are mentioned. One of the objectives is to retire at age 60. Another objective is children's education. Then the person also wants to buy a holiday home and needs to make a down payment. And also the client has certain preferences to growth-oriented sectors also, and also wants some sort of a passive income strategy. So roughly, to break it down, overall, if you look at the portfolio construction, the core of the portfolio, the bulk of the portfolio goes to a much more risk-managed portfolio, a diversified portfolio. So for retirement, you see the implementation is a global portfolio, which contains equity, bond, and gold. Time horizon is 20 years. It is balanced risk profile. And again, because the time horizon it's a little longer, the client is happy to take a higher downside risk portfolio, somewhere around 20% risk. Then the next particular goal, again, a core standpoint, is children's education, which is 12 years down the line. Again, a globally diversified portfolio across equity, bond, and gold. For this particular goal, the time horizon is a little less, around 12 years. So the downside risks chosen for this portfolio was a little lower as well, as at 15%. And then the third core goal that the client has, a little bit more short-term goal of essentially buying a holiday home. So because this home down payment will be needed to made in Singapore dollar terms, so the client doesn't want to take a currency risk. So potentially, instead of keeping the money into the bank account, the person or the client puts the money into our risk-managed REIT portfolio, which basically has REITs plus government bonds. So with a 5-year horizon, that is a pretty good strategy because it helps you get a decent amount of income or interest, but at the same time preserves your capital, right? So these become more of your core elements of the portfolio. And then essentially from a satellite standpoint, because again, the retirement is only happening 20 years down the line, John is able to afford a little bit higher risk, but not to the very big portion of your portfolio, but a 15% allocation goes to the equity 100 portfolio to focus on growth oriented companies, right? And similarly, over a long horizon, say 20 years, the client wants to generate a passive income strategy. So for now, the client doesn't mind to go into a 100% REIT portfolio because the objective is to grow the wealth and in Singapore dollar terms. And later on, as he approaches the retirement age, he can convert it to an income strategy and choose to pay out the dividends as acquired to his bank account. So this becomes like a very good way for someone to visualize how they can create a core satellite portfolio using Syfe strategies. And again, if you want a little bit more in-depth analysis, how these could be relevant to you and how you can build a custom portfolio specifically designed to your requirement. As I said earlier, please feel free to reach out to us. We have a dedicated advisory team, so we can help you out in terms of designing a portfolio such as this. All right, so before going into getting started, Melvin, I'll pause here again.
Great. Okay, so one interesting question is, there's a attendee that wants to know, how does Richard's portfolio look like?
Well, you got to take into account, that I'm nearly 70 years old, so I'm basically kind of maybe different than most of you guys, and so obviously what I need current income. So most of my portfolio doesn't look like this because I don't need growth now, right? What I need is income. So most of my portfolio is really in income. Although I do have a little bit, in the growth aspects of it, but the bulk of it is really, looking at REITs and dividend income.
Right. And just to add on, actually my portfolio looks a little bit more closer to this. And again, the reason being, someone who is 30s, 40s, I think they would want a little bit of stability, but at the same time, they would want to also, participate and take views on certain, sectors, which are high growth per se, right? So high growth, high return, but, it doesn't derail them from their end goals, even if, there are, market fluctuations for those particular satellite portfolios per se.
Great. So perhaps one more question. Will the equity component of the global portfolios match the equity 100? Because Triple Q is missing, and the S&P is obviously it's the Ireland domicile one, so there's still a slight difference. But is there a chance that the global one will match it?
Right. So Richard, I think you can cover this, right? So
well, okay. Basically, when we created the equity 100, it was a carve out, from the global portfolio. But what we did was we then also, added some aspects to it, the growth and so forth. And the idea really is that we will actually merge these portfolios so that the global portfolio over time, you see, okay, let me just digress for a minute. When we rebalance our portfolio, one of the big complaints that we have about our global portfolio is that because we're driven by risk, we tend to rebalance the portfolio. Now, when we rebalance the portfolio, the feedback from the clients typically tend to be not so positive, right? They say, what are you doing? You're trading and all that kind of stuff, right? So what we try and do is we try and manage that process so that when we actually merge these different products, we will merge it over time when we rebalance your portfolio. Okay, so the whole idea is that when we rebalance, then what we will do is we will see how we can improve it and basically merge, the equity 100 into your global portfolio. So over time, over time, not meaning years, but over time, over the next few months, we will basically, merge your portfolios, because all of the people that actually invest in a global portfolio, you notice that your portfolios are all customized at this point, right? So typically the rebalancing cycle depends on, when you entered and then when the risk basically picks up and so forth. So, but the short answer to it is yes, we will basically incorporate the equity 100 into the global portfolio.
Any other questions?
A lot of people expect REITs to be badly impacted by COVID, and people don't seem to think that there's any need for physical rental space with the work from home arrangement. Do you think the 5.1% yield is still achievable, or this will be lowered down in the long term, given REITs is also emerging to the new normal?
Right. I think a great question. So overall, I do believe that the dividends will, take a hit in the near term. So a 5% plus dividend yield is something that I don't anticipate will actually, get realized in the near term. But I'm fairly optimistic that, we should not discount the real estate market totally from the standpoint that, yes, there would be some structural impact to the whole sector. But that doesn't mean that the REIT managers will just going to sit idle and not sort of look for alternative ways to fill up the lease spaces per se, right? So my view is that overall, if you look at the overall REIT market, there are different sectors per se. While office REITs and retail mall REITs have borne the brunt of the current pandemic situation, there are other REIT sectors that have done really, really well. For example, the logistics REITs, the warehouse REITs, the industrial REITs, the healthcare REITs. They've done like really, really well. And actually some of them are trading at all-time highs from that standpoint. So I remain very, very optimistic on those REITs in terms of long-term yield generation and sustainability of those yields per se as well. More on the retail and office spaces where I think there would be some structural changes that need to be done. But the fact that most of the office space REITs do have long-term leases locked in, the REIT managers will have sufficient amount of time to sort of, think through how to restructure and revamp sort of their, overall portfolio per se. And just to give you a quick example, if you look at what happened in the US, it's an extreme example. Some of the office REITs or some of the retail mall REITs were actually converted to, Amazon fulfillment centers, right? Again, that's an extreme case. But the point that I'm trying to make is when you have a physical real estate present, you can utilize it in different ways. And given that Singapore is a contained landmass, I believe that real estate will always have a very high sort of, value attached to it in terms of, tangibility of it. And in general, the support from both the government as well as the central bank here in Singapore is fairly high to the REIT market. REIT market in Singapore is very, very liquid. It is the second biggest market across Asia Pac. So I remain fairly optimistic, and overall, from a risk-adjusted standpoint as well, REIT market in Singapore tend to give the highest sort of dividend yields per se across this region. So again, I do expect the dividend yields to be cut in the near term. Some of the REIT managers, specifically, retail malls and office REITs have borne the brunt, and they might need to structurally change their business models and all. But overall, I think if you're looking at a 5-year, 10-year horizon, I remain fairly optimistic, and I think I'll be, you'll be really happy to be buying into REITs now if you have that 5-year, 10-year horizon per se.
Yeah, I think I would add, it's just reinforce what Ritesh is saying in the sense that, if you look at the short term, I think it's pretty unrealistic to say that this year we will get 5% dividends, right? Even the banks, the MAS has come out and said, look, you shouldn't pay more than 60%, of last year's dividends and so forth. And of course, the banks got clobbered today, right? But the fact is that in the short term, you wouldn't get 5%, but certainly you would get better than what the banks are paying for deposits, which is like 0.3% or something like that, right? But as Ritesh was, I guess saying, really you should look at it on a longer term basis, because when you look at property, the property cycle is quite long, right? So the whole idea really is that you want to buy this because you want income, and this income, although it's not 5%, is probably better than anything else you would get, right? And the other issue that you should also focus on is that that's the reason why we buy a portfolio. And you notice that the allocations tend to be on the bigger REITs. So Ascenders, Maple Tree Capital Land, right? And the key thing is that, you don't want to have a situation where you buy a REIT and, you say, oh, this is great because of this reason, right? But at the end of the day, the guy goes bankrupt, and so he cannot recover for the long term. So one, of course, to be in there for the long term, you have to survive the short term. And to survive the short term, you need deeper pockets, right? So if you buy a portfolio like this, right, of SGX leaders, right, these guys have all deep pockets. They have the network. They have the support, right? So at the end of the day, you are there for the long term, and the long term you will still be better off, right? Does that make sense?
Yes.
Okay.
All right, so let me quickly wrap up the session. I think we are already close to 1.5 hours now. So let me quickly wrap up the session as to how clients can get started on the Syfe platform. So it's really straightforward. Go on to our website, www.syfe.com, or download our app now, both on Google Play as well as Apple App Store. Syfe app is available. There is a risk analyzer, so there is a get started button. So click on it. You will get asked which portfolio you want to choose or get started with. Choose your portfolio. It'll get you through a risk profiler. Once you answer the questions, it'll show you the actual portfolio that you want to invest into. You can do and play around with the forecasting tool as well. I think this is a pretty cool tool to play with because you have goals, you have sort of value attached to those goals. What kind of lump sum and monthly contributions do you need to be able to achieve those goals? So it is pretty cool to be using this forecasting tool to sort of determine that. And then once you've created your account or determined which portfolio suits you to begin with, you get onboarded and you transfer in funds, and then you can visualize your portfolio, and everything is transparent. We show you what is the current value of your portfolio, what is the investment amount, returns, data of what are the constituents of your portfolio, in what proportion, all transactions are recorded, all fees are disclosed. So it is 100% transparent in terms of how we show your portfolio is growing, as well as all the details around it. Now I think the great part about all of the good things that you get from the Syfe platform is there are no hidden charges. So it is an all-inclusive pricing depending on how much you invest. So it starts at 0.4%. There is no brokerage cost. There is no entry charge, no exit charge, no minimum balance. So you can start with any amount that you like. There is unlimited withdrawal. So there is no lock-in of your money. And again, like we take care of any costs associated with rebalancing of your portfolio or dividends that need to be reinvested, or if you transfer funds on an ongoing basis through a DCA strategy, there is absolutely no brokerage cost involved, right? So all of those are borne by us. So from your standpoint, you only need to care about the total sort of management fee that you're paying to Syfe. So essentially, depending on how much you invest, if you are on the blue side where you invest less than 20,000, you get 0.65%. If you are 20,000 and above in terms of your total investment value with Syfe, then you fall under 0.5%. So just to give you some context, right, 20,000, 0.5% basically means $100 for the entire year, right? So that's what you're paying. And again, if the more you invest, we give you and pass you, all the benefits of scale that we have developed on our platform, and pass on those benefits in terms of, lower pricing. So gold clients enjoy an even lower management fee from us. And again, the point being that, for the more you invest, we are able to also give you a little bit more higher touch service in terms of access to our financial advisors. But for every client, whether you are blue, black, or gold, you do have access to us at any point of time. So feel free to engage with us as you look at our portfolios. And as I said earlier, so Melvin is with me, so he's right there. He's our superstar. So please feel free to reach out to us and schedule a call with us. And any questions that you have, maybe through this session we might not have been able to answer take each and every question. So please go to our website. There is a way for you to schedule a call with us, and we will speak to you and get through your specific situation, and we can help you sort of create a specific plan for your particular need. And then just as a token of appreciation for you to join on to our platform, there is a small promo code that we have over here. So if you invest, you can receive up to $100, depending on how much you sort of fund your account with. So please, fill in a survey that will come up when you click on this, or take the QR code, a snapshot, and post the survey fill up. You will be able to claim your promo. Right. So with that note, I will pause here a bit. I think we might have room to take a couple of questions. Richard, are you okay?
Yeah.
Right.
It's getting a long session.
All right. So I'll pause here a bit, and Melvin, we are able to take a couple of questions, I guess.
Okay, so this is an interesting one. What are your thoughts on the capital war risk suggested by Ray Dalio? If the dollar dominance starts to wane in the future, how is Syfe looking to adapt to this change in a global investment environment?
Right, I think definitely a question for Richard. Right? So, Richard, you are the risk parity guy, so yes, I mean. Please.
Well, okay. Well, the thing is actually when we create portfolios and so forth, we really don't. We're not sort of global macro hedge fund guys, like Ray Dalio, right? So Ray Dalio obviously, invented risk parity, and one of the reasons he invented risk parity was he didn't call it risk parity, he called it the all-weather portfolio, right? Now he invented all-weather portfolio because what he was saying is, look, as I grow older, my kids may not have the same kind of expertise that I do, and so what you want to do is basically be able to create a sensible product that they can understand and they can participate in, right? And so the whole idea really is that when we actually adopt some of the principles of risk parity and the global market portfolio, we don't really look at macro and say, well, where's the market going, and how do we take advantage of this particular, in a sense, arbitrage, right? Because most hedge fund guys really look at arbitrage. So what we look at is we take systematic risk and we get paid a risk premium for it. Okay, so that is thesis number one. Thesis number two is that we basically manage risk. Okay, so in that sense we are reactive, but because past risk can basically correlated, very highly correlated with future risk. We can actually more or less forecast the risk paradigm from a backward-looking kind of a framework, right, which is what we do. So the whole idea really is that we manage from what we see and what we can measure. We don't basically hypothesize and say, well, the US dollar is going to go down, gold's going to go up, therefore we allocate more to gold. Okay? Or, we don't basically take these proactive trading decisions, right? And so the whole idea is to build a systematic portfolio that we can actually write an algorithm around and basically invest according to the algorithm. We backtest it rigorously in the most robust way. And then basically we have confidence that this will work over time. Now, what happens if you have a paradigm change, right? Paradigm change, nobody's going to help you with that, right? But so far, when we look back, essentially the market's been there. People have been adapting, okay? So in that sense, I guess the big bet we're taking is that there's no paradigm, there's no huge paradigm change, right? Like all of a sudden, for example, if the world goes away from the US dollar and goes to Bitcoin, right? What do we do? I don't know, right? Because it's never happened before.
Right. Melvin, maybe one more, or
Okay.
If there are any other burning questions that we have still not addressed.
There's another interesting one. So can you share the potential market impact of Trump being re-elected or voted out?
I think it's very hard again, but I think I shared some statistics earlier during my presentation where if you looked at history, and again, history is no sort of determinant of what will happen in the future, but if you just look back in history, if an incumbent president gets re-elected, on average, the US market gets up or goes up by 5%, versus if the incumbent loses, then the US market goes down by 3%. right? So that is like some framework for you to work with. But again, I mean, I don't think you should totally base your investment decision just based on like, who you think will win or not win per se. I think overall what I believe is till the point of election in November, the markets will remain very volatile. There will be opportunities. So keep a lookout for those opportunities. Again, it is very hard to time the market. So the better way would be to, have a dollar cost averaging sort of strategy going in, because again, like, the market has come back up from like the lows of, the March 23rd. And now it is like at 3,200, but no one knows. I mean, it can, go up to $4,000 as well, like before the next crash. So the point is, a DCA kind of a strategy into a, portfolio can help you mitigate that kind of a situation rather than you trying to time the market with a view on who gets elected or who doesn't.
Great. Okay. Okay, another question I think is, could we transfer money to Syfe account and choose when to invest in the portfolio?
Good question. So right now, not yet. Essentially, right now, I mean, the way it is structured, the whole control is at your end. You can actually set up a standing instruction in your bank account, where if you want to automatically, deposit X amount of dollars on a monthly basis to your Syfe portfolio, you just set up a standing instruction with that portfolio's reference code in there. So in a way, you can change it at any point of time at your end to change the amount or change the frequency and all of that, right? So right now, we don't have a holding portfolio per se, from which you can then transfer across to multiple portfolios that we offer. But that should not sort of limit you from achieving the objective that you have in terms of sort of deploying funds periodically, having a standing instruction in place, basically.
Great. So I believe that's all the time that we have for today. So if there's any other questions, do reach out to us. I think we can just drop a link in the chat. So give me 1 second. So I've shared the link in the chat. So if you guys want to reach out to us, just head on to the website. And anything else to add?
All right, no, that's great. So thank you everyone for joining in today. Hope this session was useful. We are always looking at ways to improve our platform as well as everything that we do. So please share your feedback. We are constantly evolving. So you've seen that we've transitioned from one portfolio to multiple portfolios right now. So catering to each and every client need that might be relevant. So please continue to share your feedback, share your experience, and we'll continue to improve. So thank you, everyone.
Thank you.